What if I told you that the most important decision for your future, your mortgage, your pension, the price of your food is not made in Downing Street or in Westminster? It's not made by anyone you voted for. It's made by a committee of 9 individuals meeting in secret inside this building. This is the Bank of England. It is not a bank as you understand it. It is the architect of the British financial universe. It decides the value of the money in your pocket. It engineers the boom that makes you feel rich and the bust that leaves you ruined. And it has done so for over 3 centuries. But here is the mystery. The question buried in plain sight. Who does this power truly serve? Is it the public good? The stability of the realm? Or was this system, from its very inception, designed for a different purpose, a purpose that has evolved into the most sophisticated mechanism of social and economic control ever devised? Today, we unraveled the true story of the Bank of England, not the sanitized version in economics textbooks. This is the story of financial alchemy, of private power masquerading as public utility, and of how your economic destiny was mortgaged long before you were born. Our story begins not with economics, but with war. The year is 1694. King William III is engaged in a desperate, ruinously expensive war against Louis XIV's Francois. 9 years' war. The crown is broke. The old system of funding wars, raising taxes or pawning the crown jewels, has hit its limit. The king's credit is so poor that he is borrowing at interest rates as high as 30%. Enter a ingenious and ultimately Faustian bargain. A syndicate of 1,268 wealthy merchants and led by a Scotsman named William Paterson, approached the government with an audacious proposal. They would form a company. They would loan the crown £1.2 million. Staggering sum. In return, they would be incorporated as the governor and company of the Bank of England, and they would be granted one singular, monumental privilege: the right to issue paper promises to pay the bearer, on demand, a certain weight of gold. This was the alchemy. The king's debt is IOU, backed by future taxes, was transformed into a new, circulating currency. The bank took the government's promise, stamped its own brand on it, and lent it back out to the public and to other businesses. It created money from state debt. This was the first and most important twist. The Bank of England was not founded with public money to serve the public. It was a private corporation that loaned money to the state and, in return, was granted the license to print the nation's money for private profit. The cage of hard money gold was not broken, but a powerful new animal was now living inside it, one that could multiply claims to that gold with the stroke of a pen. Over the next 2 centuries, the bank's power grew in lockstep with the British Empire. It became the banker's bank. Other banks held their reserves at the Bank of England. In a crisis, they turned to it for liquidity. But how did it really work? To understand this, you must grasp the original trick. Fractional reserve banking. A goldsmith and early banker accepts 100 gold coins for safekeeping. He issues paper receipts. He notices only a few people ever claim their actual gold. So, he lends out 90 of the physical coins to a merchant, but instead of giving him the gold, he gives him new paper receipts. Now, there are 190 paper receipts in circulation, but only 100 gold coins in the vault. Money has been created from debt. The Bank of England supercharged this by guaranteeing to act as the lender of last resort after the crises of the 19th century. It gave commercial banks the confidence to play this fractional reserve game more aggressively. The system's stability became dependent on the bank's promise. The bank's power was subtle but total. By controlling the price of gold, the bank rate, it controlled the cost of credit for the entire nation. A low rate would fuel railway manias and industrial booms. A high rate would cause bankruptcies and unemployment, deliberately cooling the economy. The business cycle was becoming a central bank cycle. And who bore the cost? The public, through boom and bust, inflation and deflation. The bank, protecting its gold reserves and the interests of its creditor shareholders, would often sacrifice full employment for financial stability. The 20th century brought total war and total spending. The gold standard, that old cave, became an unbearable constraint. To fund the cataclysm of World War I, The Bank of England had to sever the direct link between its notes and gold. The public was told it was temporary. It was a one-way ratchet. After the war, there was a half-hearted return to gold, but the system was brittle. The Great Depression shattered it. Then World War II demanded another ocean of money. The post-war settlement, the Bretton Woods system, created a new global cage, but with a fatal flaw. The world's currencies were pegged to the US dollar, and the dollar was pegged to gold. But the Bank of England and other central banks could now create pounds against their holdings of dollars. The anchor was now one step removed, and then came the final cut. 1971. Nixon closes the gold window. The Bretton Woods system collapses. This was the pivotal, world-altering moment for the Bank of England, though few in Britain realized it at the time. The global monetary system was now completely untethered. The pound sterling, like all major currencies, became pure fiat money by government decree, backed by nothing but trust and the threat of law. For the Bank of England, this was liberation and absolute power. The final external constraint on money creation was gone. The old discipline of the gold standard where printing too much would lead to a run on your reserves was over. The bank could now, in theory, create unlimited amounts of money. The cage was not just open. It had been dismantled. The alchemists were now free to turn not lead into gold, but paper into perceived prosperity. The immediate consequence was the great inflation of the 1970s. Unleashed from the gold anchor and pressured by governments to fund lavish social spending and powerful unions, the money supply exploded. Prices followed. Inflation hit over 25%. The pound in your pocket was melting before your eyes. This was the invisible tax in its rawest form. The bank's money creation was silently confiscating the nation's savings. The public felt robbed because the fix arrived with Margaret Thatcher and a new ideological consensus. The bank would be given operational independence to focus on one holy grail: price stability. The weapon: interest rates. By brutally raising interest rates, the bank crushed inflation, but also crushed industry, manufacturing, and created mass unemployment. It was a sledgehammer to kill a virus. The medicine was almost as deadly as the disease, but from the ashes of the 70s and 80s arose a new dogma: the Great Moderation. From the mid-1990s to 2007, inflation was low and stable. The economy seemed to grow smoothly. The bank's Monetary Policy Committee, MPC, granted formal independence in 1997, was hailed as a technocratic miracle. They had tamed the cycle. But this was another illusion. The stability wasn't natural. It was manufactured by a new, even more powerful form of alchemy. What the bank and the world had discovered was that by using interest rates to carefully manage the cost of credit, they could encourage a controlled, perpetual expansion of private debt. The explosion was no longer in consumer prices, CPI, but in asset prices: houses, stocks, commercial property. These became the new repositories for the money the system was creating. The public, seeing the value of their homes soar, felt wealthy. They borrowed against this paper wealth to consume. The economy hummed, but the foundation of this entire edifice was not productivity, not wages, not real wealth creation. It was ever-expanding debt, sanctioned and facilitated by the Bank of England's monetary policy. They hadn't abolished the boom-bust cycle. They had merely asceticed it and postponed the bust. The debt-fueled house of cards collapsed. The global financial system faced oblivion, and the Bank of England, like its peers, reached for the only tool it had left, the ultimate expression of its fiat power. It was called Quantitative Easing, QE. The Bank of England doesn't print physical cash. It creates digital money, bank reserves, out of nothing. With this electronic money, it buys government bonds, gilts from financial institutions like pension funds and insurance companies. The goal: flood the system with cash to lower long-term interest rates and spur lending. But here is the shocking truth of what QE really was. The bank created over £800 billion of new money in little over a decade. To put that in perspective, it created more money in 13 years than in its entire prior 317-year history. And what was the result? The The new money didn't go to the real economy. It went into financial assets. It inflated the wealth of those who already owned them. The top 10%, the top 1%. The gap between asset-owners and wage earners became a chasm. QE was the greatest engine of wealth inequality in modern British history. Then came COVID-19. The bank didn't hesitate. It launched another £450 billion of QE. Combined with government furlough schemes, it prevented economic meltdown, but it also poured jet fuel on asset prices, locking a generation out of home ownership and creating a crushing cost of living crisis when that inflated money finally hit consumer prices. And now, we face the final paradox. The bank is now trapped. It raised interest rates to fight the inflation its own policies helped create. But those higher rates now threaten to crash the very asset market's housing that it inflated, and bankrupt a government staggering under debt that is suddenly more expensive to service. The bank's tools are now blunt, contradictory instruments. It must choose between crushing inflation and crashing the economy. Its power is absolute, yet it is powerless to create real, sustainable prosperity. It can only manipulate the tokens in a game it design a game where the house always wins, and the public bears the ultimate cost of both the boom and the bust. So, as we reach the end of this 3-century story, what are the 3 undeniable truths you must understand about the Bank of England and your future? Truth 1. The bank is the architect of financial reality. It does not respond to the economy so much as it defines it. The price of your mortgage, the returns on your pension, the valuation of your home, the erosion of your savings by inflation. These are not acts of God or the free market. They are the outputs of a complex financial model managed from Threadneedle Street. You are not a player in this game. You live on the board. Truth 2. Its primary tool is the management of illusion. The bank's genius is its ability to trade short-term stability for long-term fragility. It makes you feel wealthy by inflating asset prices with cheap debt, while the real purchasing power of your labor stagnates. It fights the fire of inflation by risking the flood of unemployment. Its power resides in convincing you that this endless roller coaster is normal, natural, and unavoidable. Truth 3. It protects the system, not a people. From its founding to bail out a king, to its role in managing the empire's debt, to its post-2008 rescues of the financial system, the bank's North Star has been systemic continuity, the continuity of the state, the banking sector, and the credit-based monetary system itself. Your job, your business, your standard of living are secondary variables. In that equation, you are a component to be managed, sometimes sacrificed, for the machine's continued operation. The warning, then, is historical and mathematical. Every fiat currency system in history, without exception, has eventually failed. The trust underpinning it evaporates. The Bank of England's system is the most sophisticated, globally entangled iteration ever created, but it shares the same fatal flaw. It is based on infinite growth on a finite planet, and on a debt compound curve that is mathematically impossible to sustain forever. The open-ended question for you is not if the current rules of the game will change, but when and how violently. When the next great crisis comes, and it will the bank's response be yet more QE, digital currency rollouts, and deeper control? Will your economic autonomy be the final casualty in the fight to save the system? If you want to see what lies on the other side of this system, the forms of money, assets, and community resilience that have survived every monetary collapse in history, then you need to watch our next crucial documentary. Hit subscribe and turn on notifications, because understanding the power that controls your future is the first and most vital step to taking it back.